Have you ever seen price break a level and then suddenly reverse? That situation confuses many beginner traders. In this video, we'll talk about breakouts and false breakouts. First, let's understand what a breakout is. A breakout happens when price moves strongly beyond support or resistance. This usually happens after price has been stuck in a range. Breakouts show that one side is gaining control. Buyers control bullish breakouts. Sellers control bearish breakouts. Many beginners think every breakout means price will keep moving. But that's not always true. This is where false breakouts come in. A false breakout happens when price breaks a level but fails to continue. Price quickly comes back inside the range. False breakouts often trap impatient traders. Why do false breakouts happen? Because big players need liquidity to enter trades. They use breakouts to trigger orders from retail traders. Then price moves in the opposite direction. This is why chasing breakouts is risky. So how can beginners avoid false breakouts? First, wait for confirmation. Don't enter immediately when price breaks a level. Look for strong candles and follow through. Second, watch volume or momentum if available. Weak momentum often leads to false breakouts. Third, use higher time frames for key levels. Higher time frame levels are more reliable. Breakouts work best in trending markets. They fail more often in sideways markets. Always manage risk when trading breakouts. False breakouts are part of trading. Even professional traders face them. The goal is not to avoid them completely. The goal is to control losses when they happen. Quick recap. Breakouts happen when price moves beyond key levels. False breakouts happen when price fails to continue. Always wait for confirmation and manage risk. In the next video, we'll talk about pullbacks and retracements.